All right, let's dive right in. Today, we're going to decode one of the most fundamental ideas in all of trading, support and resistance. We're going to learn how to read the story that every single price chart is trying to tell us.
You've seen this happen, right? You're watching a stock, it's climbing, and then, bam, it just hits an invisible wall and turns around. Or maybe it's falling, and then it finds an invisible floor and bounces right back up. Well, that's not random. Those invisible walls are exactly what we're talking about, and understanding them is everything.
You know, the easiest way to think about all this is with a really simple metaphor, just a floor and a ceiling. Seriously, imagine the price is a bouncing ball, and it's just stuck in a room. This one idea, this is the key to unlocking everything we're about to get into.
So on one side, you've got support. That's the floor beneath the price. It's a level where buyers start to get really interested. They start thinking, hey, this is a pretty good deal. And they step in, stopping the price from falling any further. And then you have resistance. That's the ceiling. That's where sellers look at the price and think, okay, this is getting a little too high, and they decide to sell and cash out.
Let's look a little closer at support, at that floor. Think of it like a safety net. As the price is falling, it hits this level, where a whole wave of buyers decides to jump in. Their combined buying power is so strong that it just soaks up all the selling pressure and whoosh, pushes the price right back up. That's the bounce we're talking about.
And on the flip side, of course, you've got resistance, the ceiling. As the price is rallying up, it hits a point where the sellers just overwhelm the buyers. People who bought it lower start taking their profits, and new sellers might even come in, betting the price is about to go down. That selling pressure just becomes too much and the price gets smacked back down.
Now, this is absolutely crucial to understand. These aren't some magic lines drawn in the sand. They exist because of us, because of collective human psychology. These are simply price points where a ton of traders have decided to act in the past, and that creates a kind of market memory. It's like sellers who missed the last peak are kicking themselves, so they put their orders in, waiting for it to get back there. Buyers who got a great deal at a low are just eager to buy more if it ever dips there again. It's all about psychology.
And this brings us to a golden rule of trading. When a price finally breaks through a support level, that old floor often becomes the new ceiling. And the other way around, when it smashes through a resistance level, that old ceiling can become the new floor. This idea of a role reversal is so powerful, and it's something traders are watching for constantly. So, okay, the theory makes sense, but how in the world do you actually find these levels on a real chart? Well, this is where you have to become a bit of a price action detective.
You're looking for clues, right? So first, you want to look for the obvious stuff. Previous highs and lows. Those are the historical turning points. Second, look for areas where a ton of trading happened, high volume. That tells you a big battle between buyers and sellers took place right there. And third, and don't ever underestimate this one, look for big, clean, round numbers.
Yeah, numbers like $50, $100, $1,000, they act like mental magnets for our brains. People just naturally anchor to them, so they place their buy or sell orders right on those levels. It's kind of funny. They become self-fulfilling prophecies.
And think of it like testing a wall, right? If a price hits a resistance level once and turns back, that's interesting. But if it happens 2, 3, 4 times, well, how you know that's a pretty solid wall. Every single time it holds, it just strengthens the belief among all traders that that level is a big deal. Okay, so spotting the floor and the ceiling is one thing. But the real power, the reason we do all this, is to use this knowledge to build an actual trading plan. Let's turn all this analysis into action.
A really solid game plan usually follows 3 simple steps. First, you do your detective work and identify those key levels. Second, you use those levels to plan where you might get in and where you might get out. And third, and honestly, this is the most critical part, you use those same levels to define your risk.
This here is a perfect picture of a classic trade setup. A trader might get into a position right near a support level, betting that the floor is going to hold. Then they'd set their profit target just below the next known resistance level, the ceiling. But crucially, their stop loss, their "I'm out of here if I'm wrong" point, is placed just below that support. That way, if the floor breaks, they're out immediately, and their loss is limited.
All right, before we wrap this up, we have to have a quick reality check. Because as powerful as this all is, it is so important that you understand its limitations. Look, remember this. Floors can break, and ceilings can absolutely shatter. Support and resistance is not a crystal ball. It's a tool that helps you understand the market structure so you can stack the probabilities in your favor. It's a framework for making good decisions,
not a guarantee of what's going to happen next.
So, the next time you pull up a price chart, I want you to see it differently. You're not going to see random, squiggly lines anymore. You're going to see a story, a battle between buyers and sellers that's playing out at these key floors and ceilings. The only question now is, where are you going to spot them next?